Hi, okay, we're going to get started just because we have such a packed agenda. I want to make sure that we get to hear from our speakers today. Again, in the interest of time, I just want to make sure that I thank TIAA Institute for their continued support. Next up, we have asset allocation with trustees and the CIO panel. Joining the panel, we have senior institutional investment officers and trustees will discuss their approaches to asset allocation and risk management in light of institutional constraints. They will also discuss their personal experiences in being effective trustees and CIOs, and they'll share some methods to how they accomplish strategic initiatives. I'll be moderating this panel. Let's meet our panelists. Today we have Cheng, CEO and CIO of Merrimac Family Office, Hemmingsen, CIO at Parkland Management Family Office, Rodney June, CIO at Los Angeles City Employees Retirement System, also known as Lasers, Tina Padilla, trustee at Chicago Teachers Pension Fund. So we'll go ahead and get started. Clark, if you'd like to introduce yourself, please.
Sure, we're a single family office. We manage money for just one person, and we're invested in hedge funds, private equity, venture capital, long only, and direct real estate.
Al, if you'd like to go next, thank you.
Sure. Al Hemmingsen, also with a single family office. I have three different siblings underneath my umbrella, so three different sub portfolios. Investors in private equity, venture capital, hedge funds, public equity, and some real estate.
Maybe we can continue to Tina Padilla.
Hello, everyone. Yes, my name is Tina Padilla. My name is Ernestina Maria Padilla, but everybody calls me Tina. I am a trustee of the Chicago Teacher Pension Fund. I am the active trustee. There's 6 active trustees, 3 retired trustees, 2 appointed by the mayor, a total of 12 on our board. And I really represent 90,000 members of the fund.
Testing. Can you hear me now?
Yes, we can.
Okay, sorry about that. Rod Jim from LA City Employees Retirement System. We are a public pension plan. We are one of the 3 public pension plans for the city of Los Angeles. We have about $22 billion in assets. We're highly diversified, and we're always looking for areas to generate alpha and to increase our returns. Thank you.
Thank you so much. And again, thank you so much for making time. I think we'd like to hear about your trajectory and how you got into each of your roles. Maybe we could get started with how we got introduced. Thank you. Clark, go ahead.
Oh, in terms of how I started with the family office?
Yes.
So I ran alternatives at HSBC for 10 years. And, at the peak, we had probably 60 billion of assets, including hedge funds, private equity, and real estate. Merrimac was one of the larger clients at the bank, and I got to know them very, very well. Like 8 years ago, they just asked me if I would come over to help run the family office, both on the business side and on the investment side. That's basically how I came into this position. But I've known them for like 15 years before I came over here. So that's basically it.
Go ahead.
Okay. Maybe a bit of more of an outside story from my end. So I joined an investment consulting firm. I was there about 12 years, heading the research team there, the research effort. I was a bit of a misfit inside of a consulting firm. There are a lot of things that you're subject to in terms of constraints that limit what you can do in terms of investment opportunities. So I had done a little bit too much public writing or speaking on certain subjects. A recruiter called me out of the blue one day. I was aware of this family's existence, but knew very little about what they were actually doing. And it turned out to be a good fit. So I guess maybe created some public visibility around my mindset or worldview on certain issues. And that seemed to resonate with some groups, and eventually a recruiter called me.
Hi, yeah, please, Rodney.
Okay. Well, I started with Lacers many years ago, working with in the cash management area and doing short-term investing. And then I moved into some other asset classes, including the public equity side, did some real estate, fixed income, and then ultimately started to run the private equity program. So I really got the breadth of working in a lot of different asset classes for the plan. When I had reached about 10 years of my tenure at Lacers, I felt like that I was ready to run an investment program sort of on my own, so to speak. So I started looking for CIO jobs out in the public pension plan world. And lo and behold, the state of Hawaii was seeking a CIO for their plan. So I threw my hat into the ring and was able to secure that position as a CIO at the state of Hawaii. And then ultimately, I stayed there for about 5 years and then moved back to Lacers as CIO for this plan. And I've been here at Lacers now as CIO for about 10 years. So that's how I essentially got into the CIO role.
Hi, my path to trustee came in 2011 when I was about to take a sabbatical. I'm an active teacher. I teach mathematics. And at the time I was teaching at Lynch, where the former president of the union, Karen Lewis, was president, and she was aware of my financial experience, my side hustle during the breaks and the summer vacation, just side hustle. I'm a mortgage broker, so I had the money sense. I'm also an entrepreneur by heart, and people know me that way. And they asked me to run that year for trustee. I ran, and I've been running since. This is my 4th term. Hopefully my last term. We'll get some people to replace me soon. But it was very important because I saw the state of our retirement savings plan, and I joined a group of 12 trustees that in my mind, we were going to turn the ship around and make it sustainable in perpetuity. That's my goal, my intention, and continues to be.
Yes, thank you so much, Tina. So that actually leads me perfectly on to our next question. We have a couple of family offices, and then we have pensions. So can you talk about how you differ in terms of your asset allocation and how you drive investment policy?
Personally?
Yes.
I was the chair of the investment committee. And while I was the chair of the investment committee, I had a little bit more, my vote, I'm only one of 12. So my voice held a little bit more weight. Unfortunately, I'm no longer the chair of the investment committee, and also no longer to voice my opinions on issues as I was earlier on. Politics, I guess, I was censored. Let me just cut to the chase. I was censored. What does that mean? Your guess is as good as mine. However, I'm very much an active trustee. I attend all of we have a first Friday where we get to meet potential managers, emerging managers, diverse managers. That portion of the fund, a lot of people felt like it's no longer needed, but I continue to voice my opinion and fight for that to continue to stay in place. As far as our allocation, the allocation is, there's a policy, we have a policy that governs that, but I was on that discussion earlier, and I feel the same way about pension funds and the governance of pension funds the same way as ESG. If we really want pension funds to be sustainable, they need to be respected as family funds. This is our inheritance. Teachers, principals, this is our inheritance. This is over 125-year fund, and it's not being respected the way it should be respected. I don't know, is that enough?
Yeah, thank you so much. Yes, Rodney, if you'd like to chime in here, as you also manage a fund that's here for perpetuity, I think it's important for people to understand what that means and how that affects the investment decisions you guys make.
Yeah, sure. So we serve the civilian employees of the city of Los Angeles. We have about 47,000 members. About 1/3 of that are retirees and 2/3 are active members. So as you can imagine, public pension plans are designed to ensure that our members at the time of retirement until the point that they pass on, that they are able to sustain their livelihood and to maintain a certain standard of living. So we have to invest with a very long-term perspective. When we do our asset allocation studies and asset liability exercises, we're looking out 30 to 50 years out into the future and trying to determine how to best structure our portfolio, at least for the next 5 to 10 years, such that over a long period of time, our plan will be sustainable. So what does sustainability mean? That means that we will become 100% funded, meaning that all of our liabilities to pay out retirement benefits and health benefits can be accomplished with the amount of assets that we have on in the plan. So we do take a very long-term perspective there. Like Chicago teachers, we have policies that guide our plan, and that really is the heart of what we do. There really isn't any decision or action that's made within the plan that is really outside of the policy. The policy, I always say it's sort of my Bible. It's what guides me from day to day on how much risk to take, and certainly details what our performance objective is, which currently our assumed rate of return is 7%. So, we structure our asset allocation to ensure that we're not taking too much risk, but we can meet our return objectives. That obviously means we have to have a very diversified portfolio. And we go through a pretty extensive exercise every 3 years to help us determine what that structure should look like. But essentially, it means that we must be a very diversified plan to ensure that we don't have bumps in the road when there are situations like what we find ourselves in today, with rising inflation and interest rates and even geopolitical events around the world. That diversification means that we are both in U.S. public equities, non-U.S. public equities, fixed income instruments, as well as private markets, private equity, private credit, and private real estate. And my team and I have a team of 12 people total. Our jobs are to ensure that we implement the policy and also anything that our board requests, if it's a assignment or to explore a certain strategy that they may have in mind. I always have to go back and look at the policy and to see if we can do it within the existing governance construct. And if we can't, and this looks like something that's going to be very attractive for us to do in the future, then I need to go back to the board and amend our policy and get approvals for that. But essentially, yes, our perspective is very long-term. We're not trying to, have, let's say, one particular good year given the market conditions. There are certain types of investments that we could take advantage of, I suppose, that could give us great returns. But if it's very short term, I have to defer and think about is that in our best interest for the long term, meaning 5, 10 years, 20, 30 years out. So we don't take knee-jerk reactions. When the markets are dropping, we don't try to suddenly shift our assets around and rebalance. We take a very thoughtful approach, and we kind of stick to our plan. And I have found that, having been in this business and seen many market cycles, that taking the more strategic approach and sticking with the plan that the board approved has always served us well.
Great, thank you so much. That's like really helpful. I will talk a little bit about that later on. Clark, do you want to go ahead and also talk about how you guys look at your asset allocation policy?
Sure. I mean, we're a family office, so we only manage money for a person. We're trying to generate the highest return that we can, net after tax, and then everything else that we generate basically just give to charity. So we're just trying to make as much money as we can and then give it away to charity. In terms of, we're not benchmarked. I think for large institutions, it makes sense to be benchmarked. The danger with that for us is that we basically don't take on much risk, where we basically try to achieve the benchmark plus 1 or 2%. And so we're trying to generate the highest absolute dollar return, which I think is a different objective. We do move our assets around, though. So if we have a view that we are heading into a recession, which I believe we are, we have taken off risk from the public markets to move towards privates or direct real estate or cash or whatnot. If the market's down 50%, I don't care if I'm down. If I'm down 45, I would be very upset. If I'm down 10, I'd be very upset. But if the market's down 50, I don't want to be down relatively less. We just don't want to be down at all. So we do basically figure out where we think the markets are moving, what asset classes, and then we tend to try to take advantage of that 1 year from now. In terms of the current environment, there's nothing you could do right now. It's already too late. Like what you had to do a year ago, whether it be taking off risk, whether it be not doing short vol, short credit, short liquidity type strategies, you'd have to already have done it. Adding on hedges right now is probably very expensive. And then a year from now, we're trying to figure out where we want to put the money. So if biotech is cheap, that's basically something we're looking at. So we're doing all the work on the managers that we like, and then when we think the time is right, we would allocate to those funds at that time, and we try to move very quickly. But that's kind of how we think. We're more dynamic. We try to figure out where the markets are going, and I think money is made basically from these points of time when you make these decisions. So when we have these changes in cycles between the downside and the upside, like this year, maybe last year and next year, those are the times where you basically, protect your principal and also generate the highest returns by investing at the right time at the bottom. The other times I'd say are boring. The markets are going straight up for 10 years with liquidity. And I think everything's done ahead of time. The hardest time to work is really right now. And it's really figuring it out whether I think we're in a tightening cycle for a while. I think we just started tightening it, just 2 meetings ago. And we have a long ways to go to get rid of this inflation problem that we have. And we're going to head into a recession. So we're fairly negative right now, and we're just trying to manage assets through that period. But we think the money is really made on the back end of this.
Thank you so much. Al, if you manage different families, can you talk about how you guys look at your asset allocation policy as well, please?
Sure. So I have 3 different portfolios effectively underneath the family office umbrella. Some of them are similar to Clark's, where it's effectively a high growth portfolio, and the goal is to give most of the assets away. And then some are a little bit more different in character. I'm a big believer in designing your investment strategy around the attributes you have or what you don't have. So as a family office, we don't have the scale of a city pension or a state pension. So we don't have the size, we don't have the scale, we don't have the number of staff. So that dictates things that don't make sense for us. A lot of our larger peers can do some very interesting stuff, negotiating terms and conditions with managers, customizing strategies, and we don't have those advantages. But as a family office, you have the advantage Clark alluded to. Our allocations are largely invisible. We have no reporting requirements or no transparency requirements to the broader world. So we can do some things that are very quick and very invisible and small. So we can invest in certain strategies that move the needle for us that aren't practical for other groups. And then there's some other things that, again, along the lines of things that we don't do. I think there's a lot of value there. We don't do fixed income. We don't do much in the way of credit. We do very little in infrastructure, or even oil and gas for the most part, because our portfolios are generally quite aggressive. So we reserve the right to have zero allocation to certain things a lot of the time and be quite aggressive and quite focused on other parts of our portfolio or other markets.
Yeah, well, I think that leads me to my next question about, since you guys have so much flexibility, have you looked at what type of programs you have for maybe emerging and diverse managers?
Yeah,
Go ahead.
Go ahead, Clark.
I mean, we look at diverse managers, we look at emerging managers. We have a clear objective, which is to make the highest net return, and diversity is a byproduct of that. But we're not having the condition of we need diversity. We need a quota of X amount of diversity to achieve a certain return or something like that. We're trying to get the highest return possible, and diversity would just be the byproduct of that. I think even within the team, there's only 10 of us in the office. We manage a few $1 billion, but it's if you weigh in 1,000 people, it's easier to manage the diversity question. But with 10 people, it's just based on the denominator, it's hard to get there. But we're just trying to hire the most dense pool of talent that we can to make these decisions. On the investment side, there's only 3 of us, and we're all generalists. We've worked together for 15 years though, because they worked with me at HSBC for 10 years. And by having a concentrated team, we can make decisions very quickly. When I was saying about being able to move quickly, like if you look back at April 2020, March 2020, the recovery was extremely violent. So there were $6 trillion of stimulus put into the markets at that time over like a 6-week period. The Fed knew their playbook. The fiscal came in too. And if you were moving slowly, you missed the entire trade. So during that time period, we had a lot of cash. And we put it all to work April 1st. It was a tough decision at the time because everyone thought that markets would dip twice before they went up. But the recovery was so violent in April and then May and then June that if you hadn't moved that quickly, you would have missed it. I think that's just the way the markets are. There's less liquidity out there, and they tend to move very, very quickly. You don't have the prop desk from the banks trading anymore. And as a result, unless you know what you're going to be doing ahead of time, you have to do all your work way ahead. You're gonna miss the trade. So we have a concentrated team, and we can make the decisions fairly quickly. We're also all generalists too. I think that's another difference between large institutions and us, is that we're all generalists. It's a harder team to produce, but given where the market structure is right now, I think it makes sense. In the old days, there's public and there was private teams, and there was a delineation between the two. I think over the last few years, that whole spectrum has basically merged, where we have hedge funds doing growth equity. Some of them are doing venture. We have some venture funds, including Sequoia, which is the preeminent venture fund, doing public equities now. It's the same thing that's happening with credit, where direct lending used to be 4% of public credit, but now it's like 15%. Everyone thinks about companies from the entire life cycle of it, from the beginning all the way till it's a public equity. And as a result, I think if you don't have like a continuum of understanding public and private markets, it's harder to invest, because for some of these hybrid funds, who gets responsibility for doing the work on it? Is it the public team or is it the private team? I think that's something that myself, we've talked about it at a couple of board meetings for Kai and some other places, that what is that optimal organization? And my view is it should be a generalist view, and you should understand all markets, all asset classes. It's an extremely difficult problem to solve, because it's hard to build out a team with basically all CIOs. But I think that's the better way to look at this market, because it's not clear as it used to be with delineated, asset classes, strategies, and whatnot. But we're structured that way. We tend to move very quickly if we have to.
Oh, you wanted to interject and
Yeah. So our family is a little bit different. We have about 10 voices or so within those 3 portfolios, and we've had more conversations, and I guess we have differing views and opinions on ESG and how we should measure it, how we should implement it, how we should manage portfolios around it. To this point, the family has decided to not have explicit, target levels or target investment amounts, but it is something we're measuring over time. The other attribute of our portfolio that's, I think, a bit interesting is, just to put numbers on it, the median buyout fund that we've committed to over the past few years is about 250 million total. So these are quite small funds. And the median venture fund that we've done is even smaller than that. So depending on the criteria of how you count, issues like emerging managers, most of what we do could count as emerging managers, depending on how you're measuring it. So a lot of those tend to be newer funds, spin outs of existing funds. So it's an area where I think naturally it aligns with a lot of the ideals of emerging managers. But at least to this point, my governance or my constituents don't want to put an explicit structure or, I guess, rules or guides on it at this point.
How about you guys over there at Lacers, Rodney? Do you guys also have any emerging or diverse managers or any programs?
Yeah, Lacers, we have a very robust and I'll say long-standing emerging manager presence within our portfolio. We started investing with smaller and emerging managers about 20 years ago, and we've been, pretty much participating with the emerging manager community since then. I will say that the early part of our program was probably not well constructed, and we ended up, I think, having a selection problem with certain managers back then. That part of the portfolio hasn't performed as well as we had hoped. So in 2012, when I came back from the state of Hawaii and joined Lacers as the CIO, tackling the emerging manager policy and how we do business with emerging managers was really revamped. We took the emerging manager policy and scrutinized it, made what I think are some very good structural changes within it that ensures that performance is the highest, objective or the highest priority, but that we would also try to diversify the portfolio out, because we recognize that diversification amongst managers, including having smaller managers mixed with larger managers. And while in the state of California, public pension plans cannot select managers based on ethnicity, race, or gender and other factors, that doesn't mean that we can't consider that. Performance always has to be the highest objective first in what we strive for. But that just means that we have to do a lot more outreach, trying to meet as many smaller emerging managers to bring them into the fold and get to know them. We feel that a very small emerging manager today could be the next Vista of tomorrow, and we certainly want to have that relationship with them. So we do kind of spread our arms out wide. We do have outreach programs. We have an emerging manager symposium that we've done twice since last year. We've done it virtually, but eventually that will be online. And I think to Tina, I think it's your plan. You had spoken about having, I think it's on a Friday. I don't know if it's the beginning or the end.
First.
We've tried to model our symposium somewhat after what you guys have done. I've always taken that as an inspiration and as a means to get to know managers. So that's how our symposium came to being. It's a slightly different format than what you do, but I wanted to give credit where credit was due. I think it's a great idea, what you're doing at Chicago. We also have our consultants that we use on board with our emerging manager program, because they really are the gatekeepers. By and large, especially for real estate and in many cases private equity, if you can't get through with the consultant as an emerging manager, you're really not going to get anywhere. So we have invited our consultants to participate in our symposium to speak on how they manage emerging managers through the process. Our board has had conversations with our consultants in public meeting, telling them it's very important to take a look at and consider emerging managers. And for me as CIO, I spend a great deal of my time trying to get out into the community, getting to know more managers as possible, and then get them into the process. That doesn't always mean that we're going to give capital, make commitments to these managers. We know that even though we're trying to allocate no less than 10% of our total plan's assets to emerging managers, there's just not enough capital to go around. So what I tell emerging managers is that building that relationship with you is most important, because we may not be able to get into a first-time fund, maybe not even into a second-time fund. But if we get to know you and our consultants get to know you, by the time we get to, let's say, the second or third time fund, we may be able to say yes. And I can tell you that building these relationships has really been proven helpful, because we have courted emerging managers for a number of years, 2-3 years. And ultimately, we have been able to make a commitment to those managers. Are we at our targets of no less than 10? No, we're probably about half there. But we recognize that this is a long-term program, just like LACERS is a long-term public pension plan, and we try to think very long-term about this. So our relationships, we hope to build these today to endure into the future. And even if we can't make a commitment to some of these emerging managers, we certainly can be helpful in making referrals to other public pension plans who may have more of a sweet spot for that particular type of strategy or that particular kind of manager. But diversity is extremely important with plans of today. DEI, we haven't really talked about it yet on this panel, but it's all part of the DEI movement, which we find at LACERS to be, very critical, very important to have diversity, because diversity is proven through research to garner better returns. And that's what we are in the business of doing at LACERS in our investment program, is to get those returns.
Thank you.
Can I follow?
Yeah, go ahead, Tina. Yeah, we're interested in your.
So what we do for our emerging managers, if they're too small or if we don't feel that they have the experience yet, we will refer them to our manager of manager. One of them, the main one is addicts. And then if they're doing well for us within the manager of managers, they get promoted. They'll graduate into direct manager. So that's how we also promote our our emerging managers. And we do, again, the policy there, and enforcing the policy is another thing that takes a lot of work, and it takes a lot of asking questions to our consultants and to staff to bring us quality. It's not about the quantity so much, because we're all in the business to make sure that our funds are sustainable. So it's not only the quantity, but the quality of emerging managers or diverse managers that we're also very interested in and focused on.
Great. Would anybody go ahead? Yeah.
I just have a question. I know I've had this discussion with different real estate groups and different meetings and conferences and stuff. For the stakeholders of your entities, is it in their interest to have more diversity and have more DEI, ESG, all that stuff? I know for a lot of pensions, I think people would tend to, and we were discussing this earlier as CIOs, whether it made sense to have ESG goals, because in the end, if you're, I think Rod actually talked about it, but as a recipient, you really care only about the fact that if you're retired, that you have the assets to live with for the rest of your life. Whether it improves or does not help ESG is really not the goal of the pension, I presume, unless it's written in there.
Well, we have members that there's members come to us and they want to make sure that there is an ESG component and a focus. And when we invest, like, we don't want to invest in, even though they might be profitable today, they might not be profitable later, and they're causing a lot of damage to our society. So things like that, our members actually do, I understand what you're saying, Clark. They just care about having the pension, the check, and that's some, but we do have a lot of active members, not only that are recipients now, beneficiaries, but we have active teachers that are members that care about how we're investing our money.
I would like to make a comment, and I want to be clear that performance is the most important objective that we have within our program. It's all about performance, but we also consider risk. So by casting our net wider and including managers who are, I'll call off the radar screen, who are smaller, are often overlooked, they may very well have great performance, but many consultants and even within the investment community, these managers get overlooked for whatever reason. And we want to ensure that when we go out and are searching for investment managers, that we haven't overlooked a manager who could potentially increase the performance of our plan. That includes looking at smaller and emerging managers. We here in the city, and it's true with most public pension plans, we use actuaries, right? So on one hand, our retirees are going to get the retirement benefit that they have earned based on service credit. And so many of our retirees probably don't care about emerging managers. All they care about is getting that check. But for the city of Los Angeles, who is the sponsor of LACERS, who sort of, they provide us a city contribution every year. That they make up the difference of whatever our investment program cannot make through the year. So if we have a bad year, for example, in performance, the city has to come in with more money to make up that difference, to keep sort of that actuarial equation balanced. And so it's in our best interest to get the best performance we can to help reduce the contribution that the city has to give us to make up the difference from our investment program. Also, members of the retirement system who are active, including myself, because I'm a member of LACERS, we have to contribute money to the plan also. It's not just the city, but we have money taken out of our paycheck. So let's say I have a vested interest to try to get the best performance. And to get that performance, I have to look at the wider universe of managers. It's not that we're just looking at emerging managers and, let's say, kind of throwing the money out the window. We treat our emerging managers who are going through our process on the same level playing field as all other investment managers. They have to come in with the performance, with the team, all of the kind of the obvious factors that one considers. But if we're only looking at a smaller group of managers, there could be a bunch of managers who we overlook. And that's really what we're trying to do, is to ensure that we don't overlook and leave on the table managers who could get us really outstanding performance, and only looking at the ones that are easier, like let's say the lower hanging fruit. We're trying to look at all the trees, up and down that trees. And some of the time we have to do a lot more work to find the fruit on the higher branches, but we think it's worth it. And I think it's also good for the industry, even though that's not part of LACER's long-term goal, is to help the industry. More competition in the industry, we feel, helps drive a better investment process for limited partners and investors like LACERS, particularly when it comes to terms and conditions and fees that we have to pay, because we pay millions of dollars in fees. So if there's more healthy competition out there, we feel that that is beneficial not only to LACERS, but the entire industry as a whole.
Yeah, and again, we see the active and our beneficiaries see this fund as our deferred compensation. This is what we work. We are not taking home our take-home pay all together. Part of it is deferred until we retire. So people have to understand that this is not a gratuity. This is hard-earned money that teachers work for now, and they worked for before. So we want to be good stewards and fiduciaries, of course, but good stewards and manage the money, because it is our hard-earned money. It's our deferred compensation.
Yeah, thank you. Al, I'm interested in hearing, perhaps if you can share a little bit about how you guys evaluate the deals or managers you guys look at.
Yeah, so I mean, I don't think anything in our process would be kind of, a big revelation for any of the professional investors who are watching this. I mean, we're looking at track record, what you've done in your past. For private assets, the proposition is basically handing your money to somebody and hoping that you'll get it back in 10 years or longer. So it's a lot of reference checks, trying to verify all of the facts and circumstances around what we've been told, trying to understand as best as possible how either your underwriting of assets, your sourcing of assets is differentiated and novel from others, which is quite difficult. Markets are competitive. So it's all of those things. Along the lines of our strategy, there are some markets that we believe are, I guess, more adversarial, or we believe the odds are much more aligned against us than for us. So, for example, the intentional tilt towards small funds, pursuing smaller deals and smaller investments, that's very much an intentional strategy of ours. Oftentimes you invest with a manager when they're managing couple $100 million. Their next fund will be 500. If they do even better, the next fund will be 800, $1 billion, $2 billion, and eventually we will fall off. And we tend to have few of those relationships, and we tend to go back to the places where we think the odds are much more in our favor.
Park, do you have any advice also on this topic, or just viewpoint on how you guys look at the deals?
Do you have any advice for which part?
Just how you guys look at deals and managers, and if people are to, given our audience, if they want to start looking at opportunities that exist, how could they be best prepared to be in line with someone that's at your caliber, for example?
I think this. So when I first started this career, I always thought it's about doing the work and being objective and doing the analysis and stuff, which I think is a given. You need to have that. But I think that over time, what you realize is that the best managers in the world are all known. And the question is just, can you get capacity and access to them? And that's purely a relationship game. So I tend to spend most of my days interacting, whether it be at meetings, conferences, lunches, dinners, whatnot. And I do all my work at night. So I'll read newsletters and do emails until like 2 a.m. And I can actually contact my team at 1 a.m. to discuss investments and stuff. But I do think it's a relationship-driven game. The venture is like the one area where returns are actually repeatable, because it's all about deal flow with the entrepreneur. So if you're Sequoia, you're going to get a look at every deal. The problem is, can you get into Sequoia? I don't know the answer to that. The other thing which I think has changed over time is that a lot of people do references from our reference list, and because there's so many lawyers involved with non-disparage agreements and NDAs, the references are completely useless unless you personally know people in this business. And if you do, there's so much information you can achieve out of it. Now, on the public market side, there's always a danger outside of just manager references in terms of insider trading and stuff, which is illegal. But on the private side, because they're private companies, there's a lot of information flow that you can take advantage of by knowing the right venture managers, crypto managers, private equity managers, and I think it's extremely valuable. They have more data on the economy than maybe the Fed would, because they're more directly involved with all the companies and stuff. And I do think it's a very much a relationship-driven game. You have to do all your work now. And look, when the Fed starts easing, maybe a year from now, I don't know when it's going to happen. I think we're going to go into we have inflation is a huge problem. I think for the middle class and for the low income, I mean, they're already spending 55% of their income on shelter, energy, and food. This is pre-COVID. And inflation at 8%, it's only gotten higher. And even if they lower inflation to 5% or 4%, it's still a bigger problem. They have to have disinflation. So I do think maybe a year from now, when the Fed starts easing, you have to be ready to move. whether that be biotech, which is interesting, whether it be a new distress cycle, which could be interesting, whether it be tech and innovation, I don't know. I think the way that markets move, and as we look at all asset classes simultaneously, I do think that the way that this market has been over the last year is that it's the de-risking has happened from the most liquid side first. So public markets, especially tech, got hit first with multiple compression. We're going through kind of an earnings revision cycle right now as we slow down. It's starting to impact consumer stocks. If we do head into recession, it's going to impact cyclicals and industrials and stuff too. Ultimately, it hit crypto quicker because crypto is probably like a 5x levered version of tech. And then it's going to hit venture and private equity over time. I think the bid-ask spread between trades is quite large right now. Sellers aren't willing to take a discount yet, but within a year, I think they will be. In terms of companies raising capital, I don't think there's much to do either. I think people are in denial, but everyone thinks they have a great company. But given all the capital they've raised last year, and given the fact that they're starting to cut burn rates, they're also starting to apply for venture debt. They're trying not to have a funding round until much later so that they don't dilute their equity. So a year from now, structured equity and secondaries could be very interesting on the private equity and venture side. Then ultimately, I think real estate is the slowest asset class. And we're starting to see rate increases affecting real estate. I think the Fed has not even started tapering yet. They have $9 trillion of balance sheet exposure, which they need to get rid of. They thought some of the stuff would roll off, but I think even when you look at like refinancing and mortgage-backed securities, no one's refinancing from a 3% to a 5% loan. As a result, it's not rolling off as quick as they probably would like, that they may actually have to start selling mortgage-backed securities, which could raise mortgage rates. But I think real estate is the last leg to move. It's the most lagged. But I think on the way down, it's going to happen across asset classes by liquidity. And on the rebound, it's going to be the same way. But if you are dynamic, you could take advantage of it, through that cycle. It could be a 3-year cycle, but you have to know who you're investing with. You have to have done all the work ahead of time.
Thank you. That's really helpful. I just want to make sure that I give the rest of the speakers a couple minutes to give more advice on just your role and getting into your roles. And then I'll open it up for Q&A from the audience. Al, please go ahead.
Okay. I guess so a couple of ideas there. Again, we've very much tailored what we do to our attributes as an investor. So if you told me today you were going to give me 50 times my current asset base, the strategy would be completely different. So for us as a modest-sized family office, it's trying to have a reputation for sincerity and speed and thoughtfulness in terms of diligence. As Clark alludes, the best LPs are choosy, and they will the best ones will do diligence on you as a GP, or the best GPs do diligence on their LPs, and they're selective, and the best ones will ask us to provide references of others who can tell them, how stable we are, how good of an investor we are, how much we are not a pain in the ass, because good managers can be choosy. With regard to references, I think, for managers who are younger in their life cycle, definitely if you're looking at the reference list that's provided, everybody on that list is going to give you a very curated answer. There's real value to the LinkedIn premium membership and finding people farther back in people's pasts. And if you cold call a few of them, it's kind of grunt work, even for CIO level. But if you're willing to cold call a few people and say, hey, we're a small family office, we're looking at investing in so-and-so. We understand that you may have worked with them, 8-9 years ago in some capacity. Would you be willing to talk to us? You get a surprising number of yeses, and you get a surprising number of people who are willing to talk to you and be pretty candid with you one way or another. Doesn't always go that way, but sometimes it does. And it's, that's kind of a labor intensive, speedy thing that we have the ability to do, because we're trying to invest, a modest amount of capital in a modest number of transactions per year.
Rodney, do you want to go?
Yeah, I wanted to say that in terms of looking at managers, we use somewhat of the same process that any smart investor would do. I mean, our due diligence process is very robust. It's a combination of both the consultant doing due diligence as well as my own staff. But I think what would be important for some of the listeners out there is to understand sort of our process. As I understand, as I mentioned earlier, building the relationships is important. So if you want to do business with Lacers, you should get to know either myself or my staff or both. We can make introductions to our consultant. For public market investments, we do everything by RFP. It's a very competitive process. So I suggest that any managers who is interested in doing business with Lacers on the public side, or even if you're a private market manager, we have an RFP, RFI subscription service. You sign on to our database, and anytime that we have an RFP that's investment related, you'll get an email apprising you of that, and then you can look at the RFP and decide if you want to submit a proposal for that. For the private side, on private equity, it's really important to get to know the consultant and staff. We use a staff and consultant discretionary policy model such that the consultant and staff, and our consultant on private equity is Axia, we have the ability to say yes and make the commitments without advanced board or IC approval. So it's a very streamlined process. But that process can take time. So again, it's important to get that relationship built, get to know us. On the private real estate side, it's very similar, but those deals go through the investment committee and the board. So that process takes a little bit longer, but I would encourage any manager who's listening today to contact me at lacers.invest@lacers.org. That's lacers.invest@lacers.org. And let me know that you'd like to have a meeting, and we'll set something up in the future and start building that relationship. I think that's really key. But just in terms of the due diligence, again, we look at performance, the track record, attribution, the team, your investment philosophy, and the process, which I think the process is extremely important. So it's not much different than what most institutional investors would do. It's probably more process-driven than maybe a family office might go through. Again, process and looking back to our policy is critical. It's what we live by, is the process. So we go through kind of that same process every time. But we think it's one that has proven the test of time. It has served us well. And most public plans do use a very similar process to what we have.
Thank you. And thanks also for making yourself available. Tina, go ahead. You have a couple minutes.
As a public fund, we do have the procurement policy, and it's pretty lengthy, and it's time, takes a longer time, I'm sure, than a small private office. But what I would recommend, and there's things, there was a question about change. Certain things do need to be changed, and it's all for the public funds. It means to go do a little lobbying and change some of the statutes or amend them. One example, there was a manager, excellent manager, who did not have capacity for us, but had a wait list. And I asked, can't we be on the wait list? And so our consultants and our staff, they were like, well, we have to stay true to their policy or our procurement process. But things have to change because, times are changing. And if we want to stay sustainable in perpetuity, it's all about getting the right managers, as the CIOs have been alluding to. And if we want to have access to them, like I said in the beginning, it's not about quantity, it's about quality. And if we want to get those quality managers, and if they don't have room for us right now because they're filled, instead of putting us in another fund, just because we need to work on things to change our process so it's a little bit more limber, be more flexible, be agile, mobile, and not hostile. Basically, that's my little chime.
Great, thank you so much. I just have one question from the audience, if anybody wants to take it. The question is from Roberto Pocas Leitao. What is your interest in allocation to opportunistic real estate strategies?
I'll be happy to take that one. We do look at opportunistic real estate, although it's a smaller part of our portfolio, but we would happy to take a look at it. So, contact me and, we'll funnel you to the right people at Lacers and to Townsend Group, who's our real estate consultant.
Do anyone else want to chime in on that?
Sure. I was going to give the quick and probably not desirable answer, but not much. We've been slow to no allocations in real estate for a few years for a variety of reasons.
Rodney or Tina?
That's one of my areas I enjoy when we're talking about real estate. And again, it's that process. It's convincing not only myself, it's convincing our consultant and our staff and 11 other trustees.
Well, I'm going to actually wrap it up since we're ahead of schedule. I really want to thank you guys for taking the time to just really grace us with your presence and sharing all your knowledge and information. And have a wonderful day. We're going to get going on the next panel discussion that we have if anybody wants to take a quick couple minutes. Thank you very much.